Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome back everyone to our sixth video. Today we will talk about buying put options. So let's get started. This is the agenda we have prepared today. We will talk about why buy puts. And anytime you buy options, we must be very aware of the deltas and the gammas and the thetas, all the Greeks. We will also recap the golden rules we need to follow. Then together we will shop for some candidates to buy put options against. Then we recap all the free tools we talked about, as well as show options play and how this makes our life so much easier. So let's get started. Why do we buy puts? Well, typically there are two scenarios. First scenario is to capture a downward speculative bearish move on a stock that you do not own. So this is one of the more risky strategies, but again, more risk means more reward. So this is only scenarios when you are using both fundamental and technical indicators to leave you to believe that the stock will fall and it's currently in an overbought situation. And you can either short the stock or buy a put. And let's just look at an example of what if you did not use this option strategy, but rather you just traditionally use it, the shorting a stock type of a scenario. So shares of an ABC company is trading at $50 a share, and you think that is too high. So you contact your broker who finds somebody else that has 100 shares and will let you borrow them for a fee. You then sell these shares and you pocket $5,000, $50 a share times 100. And 2 weeks later, some bad news happens and the stock falls to $30 a share. At that point, you really buy 100 shares now for $3 at a cost of $3,000, thereby you pocket $2,000 in profit. But you must be aware when you short a stock, there is cost involved. Brokerages make money, commissions, and there's also charges and interest, as well as the cost of borrowing the stock from somebody else. You're literally renting it. So, and also if the company pays a dividend during the time you borrow the stock, you must compensate the owner as well. And if you forecasted wrong and the stock rises, well, there is theoretically no limit to how high the stock can go. So you could be in a position of unlimited risk. So it's a very risky and inefficient scenario. Whereas if we buy the puts, let's compare. The stock short strategy costs you $50 a share. 1,000 shares is a $50,000 investment. And if you're lucky, the stock drops by $5 to $45 a share. You've gained 10%, but you've taken on unlimited risk doing so. I would personally then use a long put strategy where I'm buying a $50 strike price at the money for $2.50 a share with a 50 delta. 10 contracts would be 1,000 shares. This would cost me $2,500. And if the stock drops to $45, well, I've got $5 put price because the $5 decrease in price has increased my put prices by 50% of that, which is $2.50. So my put price has increased from $2.50 to $5, giving me a 100% return on my money. And my risk was $2.50 per share. And I never even touched the shares. I literally just close out my position and sell my $2.50 put price for $5 and gain 100%. So one of my favorite reasons as to why trade options is the asymmetrical reward to risk ratio. I don't see this in many other investments. And you can see clearly it's a higher return on investment by percentage, requires a fraction of the capital, and sometimes you need to have a margin account to pull this off. But again, risk exposure is limited. So there's very few reasons why use a short stock strategy instead. And this compares both scenarios. And what if the stock turned the other way and went up instead? Well, you can see on the right hand side, the most we can ever lose is $2.50 a share, so $250. But the person who shorted the stock with the traditional method has unlimited risk, and at $65, that person would have lost $15,000. Likewise, on the other hand, if the stock does drop as you forecasted, as you can see, a $10,000 gain because of a $10 drop in the share price, the put buyer would gain 50% of that, which is $5,000, but $5,000 on risk capital of $250. So you can clearly see it's a much better asymmetrical reward with limited risk. And again, you only do this when the technical indicators and the fundamentals give you reason to believe it's in an overbought position. Scenario 2 is actually much more common and is one of Warren Buffett's favorite, and it's called a protective put. So this is where you are buying insurance to protect the price of your stock. And so let's assume an investor purchased 1,000 shares at $40, and now it's currently at $50, and we're looking to buy some insurance against that. So a 3-month put contract may be $2 in premium at a $50 strike price. So it costs $2,000 to protect this position to ensure that he or she can sell the shares at $50. No matter how low the price drops, this investor is insured. But also, the put increases in value as well. So this does lower your break-even point and even further reduces it as the share prices keep dropping. Remember, we talked about delta, one of the most important aspects of the Greeks, where this is the relative change of the option price to the share price. Calls have positive delta. In this case, for puts, we have a negative delta. And this is what you need to remember, and it will become second nature shortly, is in the money options will move more than the other money option. That's why most option contracts are near or at the money. And gamma is the rate of change of the delta. And the thing to remember here is the price of the near term at the money will exhibit the most explosive response. And that's why, again, most options are traded near at the money. Theta is time decay, and you must remember when you buy options, unlike the prior video where we talked about selling options, here you're buying the options, time decay works against you. So you do need to realize and determine how far out the expiration dates that you select. But again, these are all within your control. And Vega is the mysterious volatility that is very hard to put your finger on. And just remember, options tend to be more expensive when volatility is higher. And there's both historical and implied. And we will show you how options play helps you take all of these variables and calculates it for you in a much more sane manner. So remember, we buy into weakness and sell out of strength. Know your entry and exit points to take the emotion away. So we are going to preset our sell orders the day after we've bought it. And never invest more than 5% of your capital in any one trade. So let's go shopping for put option candidates, and we're looking for ones with high RSI signals in an overbought position because no stock can rise forever. So there will be some profit taking to follow. And we're using the Toronto Stock Exchange as an example. These are benefits of the Canadian equities. One is diversification from the US dollar. It's a safe political climate. Very stable economies, often the strongest of the G7, and we have the best bid-ask spreads for Canadian stocks compared to the same companies listed in New York, and these are some of the more bigger internationally recognized companies in Canada. So let's start with our free stock charts tool again, and we will go to the TSX 60 index and search for these alphabetically. So this one at 76.38 for the RSI for ATB.B. We will continue alphabetically going down one by one. And next one that seems interesting is EMA at 74.74. And we will keep looking. FTS 78.32. So that seems to be our candidate right now. Has a very sharp rise in the short term. And let's go for the rest of the list. And towards the end, nothing else is close. So let's go to options play and help us manage this option strategy with some tools that are much more easier to use. So we will put the stock symbol for FTS. And this is giving us a bullish long-term and short-term trend, but we don't think it can rise forever. So I actually will select a bearish strategy, and it's suggesting by default buying a December 21 $46 put. I will modify this and just compare and do a little analysis. And what if I compared it to a shorter expiration, maybe to a longer expiration? As you can see, the longer time value I buy, the more expensive the premium will be, which makes perfect sense. And I may just go with a January 2019 $46 put instead. And that's the example we may use today. And when I trade, this is the actual strategy I will be entering into my platform. So I'm buying to open one FTS January 18 46 put at $1.42 per share, $142 total. And I'm also going to use the simulator here to compare. What if it drops to a certain price? What is my return? So if I go to $40, my return will be $378 profit, 266%. And if I get there sooner, even greater profits. And you can also play devil's advocate. And what if the stock goes the other way? As you can see, the most I can ever lose is $142. So there are no other tools out there available to help you make this kind of analysis. So let's repeat this for our Asian visitors and viewers. Bearish strategy, we will modify, select various expirations to compare, and we will again settle on this January 18, 2019, 68 days to expiration with the 46 at the money. And if I trade it, this is how we enter the trade. Buy one FTS January 18, 2019, $46 put for $1.42. So next we go to our trading platform. You can get your free trial here at this URL. Available in a number of different languages. And I will log into my web trader platform. Your particular broker will vary, but the concepts and strategies are the same. So we select our options, and then we enter FTS to get the options chain. Select the Canadian Toronto Stock Exchange, and here are the options expirations available. We will select January 18, 2019. The puts are on the right hand side, as you noticed. So we're buying one FTS January 18, 2019, 46 put FTS. And rather than taking the default price, I will go 1 penny above the bid price and get ahead of the line. I'm not that desperate, so I will not go with the ask price. We want good to close. Preview my order. And there is my order. Buy one FTS option. 46 put, $1.36. I don't want to pay the full asking price. And submit my order. And this is how you trade a put option. So recap, here are some of the free tools we showed you. We are always using freestockcharts.com for the technical analysis, and there are other tools available on the Macintosh platform. Financial is one of my favorite new tools that help me give a little bit more accuracy in my stock movement forecasting. Here's the URL for your virtual trading account, available anywhere in the world. For Canadian equities, this website is invaluable. For options chain in Greeks, the investing.com is terrific for American equities, as this tip ranks to give us a forecasting by various analysts. FinViz, very detailed information on all equities, as well as the map, a wonderful tool to give us a visual aspect as how markets are doing by various verticals. More Canadian options information is available at the m-x.ca site. And optionmatters.ca, keep an eye on that for new articles by industry experts. I would invite you to visit macrovoices.com, which is a weekly Thursday podcast with updates on how the macroeconomic conditions are changing. And for the Options Play Canadian Equities edition, here's the URL to get your free account there, paid for by the TMX. And for American equities, please visit one of these two sites to sign up for your 1-month free trial. So just to summarize, remember, continue your journey at our website. It's like learning any musical instrument. You must learn, practice, repeat, tell your friends about us. And please subscribe to our list on our website for new trade ideas and updates. And try our mentoring services in our marketplace at DLBS.ca once you've absorbed all you can with our training videos. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat. And if you found it useful, please share it with your friends and family. See you in the next video.